Hello and welcome to the latest market update with me, Andrew Dawkins, and
myself, Daniel Bajwoluk. Hello again, Andrew.
hello Dan, nice to see you.
Nice to see you. How was your holiday?
The holiday was very, very good. Yes, nice to see some sunshine.
Yes.
And some heat.
We haven't been experiencing that for the last few weeks, that's for sure. We've had a terrible summer thus far. Well, hopefully it's not the end yet. We're not there yet. So hopefully, fingers crossed, Indian summer on its way.
Let's hope so. Yes. Indeed.
So it's good to have you back, Andrew. So let's talk about the previous month of June and how the markets went, how they fared. Do we want to or not really?
I think it's a repeat of it's a repeat of May, perhaps even worse than we had in May, which is all down to the rate of inflation throughout most of the world, which continues to increase, which then causes markets big worries because until they see an end of inflation, or inflation starting to top out or even start to fall, then it's the unknown, and that causes then the great pessimism within the world. And I think one of the disturbing, disappointing features is there's so many analysts throughout the world now saying recession, and it's almost like they're wishing for a recession rather than saying, well, actually, when we look at the world economy, in many areas we're doing quite well. I mean, Europe and the UK in particular, we've got full employment, the lowest unemployment rates in America since 1961. So in a lot of respects, we're doing quite well.
That's strange.
Whereas if you were entering in a recession, ordinarily in a normal cycle, you would expect to see unemployment ticking up quite significantly, but that's not the case here. So interesting period, which is really all on the back of the cheap money that was pumped into the markets ever since 2009, but then increased significantly at the start of COVID. And that prevented, true enough, many people sort of being on the breadline in terms of being paid to stay at home and away from work. But the payback is now we've got to accept that there's a huge amount of cash waiting to be spent, but we've still got difficulties with supply. So until the supply chains get mended, then I think we're still in for sort of some quite vicious numbers when it comes to inflation. Not a great June really. It's much of a replay as we had in May. Perhaps slightly worse because of the fact that the inflation figures show no signs of slowing down. Although there's some costs now which are starting to come down in terms of raw materials, which will eventually be passed on to the consumer. But the difficulty is that we've still got fuel at a very, very high level. And that makes up a major part of inflation figures because even if we're not heating and lighting our homes to the same extent as we were in the winter months, then we're still wanting to do things like get away, go on holiday, even if it's a holiday in the UK, never mind abroad. That all needs fuel, energy, etc.
So it does seem a little bit dire just now, but looking back in history, I know we always look back to sort of have a bit of an idea as to where this could be heading. Is there anything in the past that sort of happened similar to this, where we can get some good news perhaps?
Well, one of the things I was looking back on was the financial crisis of 2007, 2008. And if we look at our capital growth portfolio, for example, which is around about 80% equity holding, it's one of the most popular holdings we have, then in 5 months leading up to December of 2008, the account fell, and it fell by 26% in 5 months. It fell by 26% in 5 months, which is higher than the falls we've got at the moment. But then in the next year, so from December 2008 to December 2009, it actually grew by 40%, 40. And then the year after that, it grew by another 20%. So within a couple of years, you're actually up 60%. And the reason for mentioning this is because one of the questions we get asked quite often is, should we move out of risk assets and move into something like cash? So within the investments that we run for the majority of our clients, we could use the cash holding. It doesn't provide any interest really worth speaking about. The challenge that we have is then timing back into the market and saying, right, well, the worst is now behind us and we'll crack on now while just making pure growth. The difficulty is we never know when that growth is about to happen. It could happen tomorrow, it could be next week, it could be next month. Mm-hmm. We just don't know. But remaining fully invested gives us the best chance then of continuing that longer term growth. So yes, we could de-risk, we could come away into cash, but then the challenge is timing the market so that we take advantage of any upturn in events. So the old saying is time in the market rather than timing the market. Long term, the results for clients that have been invested for 3, 4, 5, 10, 15, 20 years have been spectacular. We've made good growth. It's unfortunate that we came off the back of a really good last year where we saw some stellar returns, and then this year has been frightening because of the fact we lost all that growth we put on last year. But I think if last year we hadn't had such spectacular growth, then the fall wouldn't have been so bad. But we were putting on crazy numbers last year, which we accept and we will take, but then the fall was that bit harder. But we're above average in terms of most funds in the UK that we advise on. So it's sort of, the good news is it could be even worse. It's no good thing. We're not taking that lightly, but I think the method really is that we pick good quality assets for the long term. Short term, we get spells like this. There hasn't really been a spell like this since we said there 2008. So it's a long time without a major market correction, which was perhaps overdue in any event.
Yeah, Andrew, a lot of our clients who have been clients for a while now would know that coming to the end of the year, there's usually a bit of a inspection on all the funds that we have and sort of a rebalance. Is that something you're looking to do now? We are coming into July, aren't we? July, start of July, end of July. So is that something you're looking at just now?
Yeah, you're right, Daniel. Once a year at least we carry out a full review, not only of our funds, we look at the funds we recommend for all our clients virtually daily, but then we compare them with the rest of the market and all the funds that we can choose from. So there are over 4,000 different investment funds types we can look at. But what we've learned over periods where there's been market movement like there is at the moment is not to make any changes during periods of volatility. So we were due a full review, a rebalance, as we call it, this month, July, but it's likely that will now happen in September/October, providing the markets are settled a wee bit. It tends to be over previous times when we've made a rebalance during periods of volatility. I hate saying this, but sometimes we get it a little bit wrong and we get carried away by the current market movements rather than taking a longer term view of it. So we have had one or two poor experiences in the past of making changes in the heat of the moment, and then later you go, well, perhaps that wasn't such a good thing to do. So occasionally we do get it wrong. I think the main thing is to admit that so that you learn from it.
Just another question, Andrew. So, as in any downturn in the market, a lot of people try to buy the dip, as they say. So, is this a good opportunity to potentially invest some money, or what are your thoughts on that just now?
Yeah, I think it depends on how much and a percentage of somebody's wealth that they're looking to put away, because I think this volatility is going to continue for a wee while. Long term, yes, we will make money. Short term, less than a year, 18 months, then it's a bit of a gamble, especially if you haven't perhaps been invested in the market before. If you put new money in and then in 6 months' time we're telling you, well, actually the value is less than it is that was invested. Mm-hmm. If that causes people to be alarmed and nervous, then we would say, well, probably just at the moment hold off. We are looking at things like, for example, premium bonds just as a short-term holding, because still the rates on cash returns are very, very poor compared to inflation. Premium bonds don't give any interest as such, but the way they're calculated, they do have the potential to give you a return, or be modest.
Mm-hmm.
And there is the potential to get that £1 million jackpot, which has to be done. So otherwise, a long term, then yes, it is a good time to invest. But as we've said many times, it's always a good time to invest because we're more concerned about the medium to long term, and that's where you'll still make money. But anybody looking to make money for a period of a year, 2 years, then it's always a gamble. It always has been, and it always will be. Even when things improve and the market's at an all-time high, then you still have to be aware that there will be these occasions where we do see values falling.
So as we do every month, Andrew, shall we go through all of the A.R.D consultancy portfolios and their performance? Should we start with the defensive then?
Okay, so over the last month, it's unsurprisingly down 4.5%. Over the year, it's down 10.6%. Over 3 years, down 2.1%. 5 years, we start getting profit of 7.6%.
Okay, and now we look at the cautious portfolio.
Over the month, down 5%. Over the year, down 10.3%. Over 3 years, up 0.81%. And then over 5 years, up 14.2%.
And look at the balanced portfolio.
This month, down 5.5%. Over the year, down 11%. Over 3 years, up 5.1%. And 5 years, up 22.8%.
We've got the capital growth portfolio.
So this is the higher equity exposure, around about 80%. Over the last month, down 5.9%. Over the year, down 11%. Over 3 years, up 9%. And 5 years, up 31.4%.
And finally, the aggressive portfolio.
And this has just over 90% share or equity exposure. Over the month, down 6.1%. Over the year, down 10.3%. Over 3 years, up 12.9%. And over 5 years, up 41.6%.